og velkommen til det her event, som vi afholder sammen med Nordnet. I dag har vi DonkeyRepublic med os, en børskandidat. Jeg tror, de fleste måske har stødt på deres produkter. Så meget af fokusen i dag vil selvfølgelig være, hvad er egentlig investeringscasen inde bagved? Hvad er forretningsmodellen bagved det her delecykeludlejning? Så det er selvfølgelig det, vi prøver at håbe på, at de næste 30-45 minutter vil give jer et indblik i. Til at hjælpe mig igennem har jeg taget Erdem med, CEO i DonkeyRepublic. Han skal nok præsentere sig selv til at starte med, så det vil jeg undlade, så vi ikke gør det 2 gange. Som altid, stille spørgsmål nede i højre side, løbende igennem præsentationen. Vi gør det på den her måde, at vi først lige løber 20 minutter igennem præsentationen, og så tager vi spørgsmålene efterfølgende. Men stil meget gerne løbende igennem præsentationen, så skal jeg nok sørge for at samle op og være sikker på, at vi kommer igennem alle spørgsmålene. Det vil være lidt specielt. I må meget gerne stille jeres spørgsmål på dansk. I må også gerne stille dem på engelsk. Jeg oversætter dem til Erdem, og Erdem snakker dansk og forstår dansk, men foretrækker altså engelsk som koncernsprog, når han skal snakke forretning. Så det håber jeg, der er en vis forståelse for. Men I må meget gerne stille spørgsmålene på dansk, så skal jeg nok sørge for at få formuleret dem ind. Og hvis jeg nogle gange switcher lidt mellem dansk og engelsk, så håber jeg, at de også tilgiver mig for det. Og det kan godt være, at Erdem gør det. Men ellers, Erdem, jeg synes bare, at du skal starte med at præsentere dig selv og den forretning, du står i spidsen for.
Tak, Michael. Hej med jer alle sammen. Jeg hedder Erdem, og som Michael siger, jeg taler dansk, men jeg foretrækker engelsk i forhold til noget forretning. So I'll continue in English. I'm from Istanbul originally, grew up there, and lived in London, San Francisco before moving to Denmark, and established Donkey together with my 3 co-founders in 2014 officially, and I stand as the director and co-founder in the company. I have a background in management consultancy. I worked a couple of years with McKinsey. I studied mechanical engineering and public policy, 2 degrees that usually are interesting to put together. And I've worked in a couple of startups before DonkeyRepublic, one of which I've also started. If that's good, and I'll take you through 10 slides here over the next 15 minutes, and then look forward to your questions and giving a good overview about Donkey. But Michael always asks me, why did I start DonkeyRepublic? And maybe I start with that, Michael.
Yeah, do that.
Back in 2012, I was teaching entrepreneurship at DIS here at the Institute in Copenhagen. And I asked the class what was the most inspiring entrepreneur for them. And one of them said Travis and Uber. I hadn't heard of the company yet. And said, yeah, check it out. And I looked and it said everyone's private cab. And I thought this was really dystopic future, because I really enjoy the quality of life in Copenhagen thanks to bikes. And something I suffered from in Istanbul and also in San Francisco and London, that you can't just get around, and quality of life does suffer from not having enough space and activity when you're in and around the city. And I was looking into why bike sharing isn't picking up as a scalable business. It was only here and there with a few cities, and figured out that there was not enough innovation and not enough drive and scalability in mind. So with that in mind, I found my co-founders and put all the activities in motion, and then here we are. So that's short story, and maybe jumping into the first slide here with the numbers. We are today almost at 13,000 bikes and e-bikes. We are a company that's served so far almost 600,000 unique riders who've ridden a Donkey. Almost 10 million trips in 75 locations in 14 European countries, those locations. And we turned over 33.5 million in 19, and a bit less in 2020 due to COVID. And we have about 63 employees, including our mechanics, 35 in the HQ, where our programming, business development, everything is done in-house with this team. remember to ask your questions, but I will take them with Michael curating after the presentation.
Yeah.
So why bike share and why do we exist? If you look at the city's goals, they really have livable cities are an important concern for cities. SDGs are clearly establishing why we need to do that. But if you look at one car trip being replaced with a bike trip, then some of the clear advantages is congestion effects. You save more than €1 per trip to society due to simply congestion effects. Emissions, half a kilo per car trip that you replace with a bike trip. And most important effect actually is the health effect, because when we keep people active, then we have fewer chronic diseases, cancer, and so on and so forth. And that is the reason that public has seen bike share as part of public transport. So none of the other micromobilities have actually received public financing so far. And bike share is seen a bit like buses and trains and metro as part of public transport. That's why they have been receiving public financing. And if you look also the effects that we are creating for public, then it also well justifies why there should be public financing. If you look at our footprint, I mentioned these 75 locations across Europe. We are strong in Denmark, but also Benelux, so Netherlands and Belgium area, and a few other important cities like Berlin, Barcelona, Budapest, Geneva. The bright points in the map are MaaS cities, which is mobility as a service, where DonkeyRepublic owns and operates the bike share. And then you have the dark brown SaaS cities, which is software as a service, where we have franchise partners who are running the bike share for us and with our brand and with our, obviously, bikes and apps. It's two business models, and it's everything run under the one brand and one solution, which is where we're building the flexibility, also with the same bikes. So I can easily say that building a standard product, both in terms of hardware, but also in terms of software, is key for our scalability. And also is key for our scalability is the SaaS partnerships, which we launched in 2018. Before then, we were having to sort of build the brand. And now we're at a point where the SaaS partnerships are really growing fast, and we're having great traction there. In the core of the Donkey software, we're actually catering to quite a few partners or stakeholders: the riders and the fleet managers, the corporates, the B2B clients we have, the cities who want to see also where the bikes are and how they are utilized. And very soon we will be fully integrated to transport aggregators. We already are showing as a sort of an option in different maps or apps where you can see Donkey price and availability, but soon you'll be able to use Donkeys also without even downloading our app. So that's the transport aggregators. We have a diversity of revenue streams, and that's really, really good for healthy unit economics and resilience. And it helps us be innovative when we want to expand. We can find different ways to make the numbers add up. So obviously we start with rider revenue, and that's the largest revenue stream we have. We have pay-as-you-go, where you just pay for one time for one trip or rental. Our rentals are not squeezed to one trip. Many of the rentals are multiple trips where people keep the bike with them, which is also a quite nice, unique feature for Donkeys. Membership is a monthly recurring revenue from the riders until they stop it, obviously. But they get to use the bikes as much as they want when they buy the membership product. Corporate and campuses, we have already 7 such clients, and they also buy memberships for their employees. And we also sell them sponsorships on the backs of our bikes where we have the side ads. Cities. Cities are paying for bike sharing, as I just mentioned, and this is a growing source of revenue for us as well as our partners. So public funding, which is a really nice long-term revenue stream. And then we have the software as a service business, where we have many SaaS partners. They can be different kinds of institutions. Most promising probably are utility operators that already operate buses and trains and so on for certain cities. Now they want to operate our bikes. But there are also different types of collaborators we have from car-related businesses, bike-related businesses, NGOs, real estate developers, and so on, who for one reason or another decide to get into bike sharing. They pay us license fees, which are recurring monthly fees, high profit margin on those license fees. And then we sell them the fleet where we have the standard bike and e-bike that we sell to them. That's not where we try to make the largest margin. The competitive view, as we see it, there are three main competition. The one in the bottom is probably the names that you have heard of most, Lime and Jump, Voi, Tier. These are companies that have raised a lot of money from venture capital, and their main focus is e-scooters, but they now also have launched some e-bikes. Their focus is tier 1 and some tier 2 cities, and they are very focused on rider revenues, not public finance. And electric vehicles and especially scooters are more expensive compared to bikes. So if you look into the differentiation, one part is clearly catering to public and to cities, especially tier 2 and 3 cities, where donkeys are a very attractive solution for cities to procure. For riders' perspective, we're much more affordable on a trip-by-trip basis. And we also offer a lot of more flexibilities for cities, like working with a local partner. Or we establish virtual stations where people return the bikes and they're not free-floated, which is also important consideration for cities. Then you have traditional providers of bike sharing, like Smooth, Nextbike, JCDecaux. Some of those big, large city systems, like the one in London or Paris. These are quite flexible and responsible. They are also focusing on tier 1, but they're also very expensive and typically work with cities who want to establish their own brand with these bike shares. And the third category is more startups like Pony, Beryl, and Bond, which are early stage in their journey, and they don't really have a full feature set. They are also looking at tier 2 and 3 markets and also looking at public financing. Donkey, I think we are the most affordable, flexible, and responsible provider, focusing on tier 2 and 3 cities, which is less than 1 million people. That is about 2,500 cities across Europe. We are having great time with riders and good traction with riders, but also with cities. So we're also collecting revenues from public financing. Okay. The next one about explaining a bit about regulation, because city and city relations and public finance is so important. So until 2016, here's a picture of Büsügün. Bespoke bike shares driven by public investments. That was how bike sharing was done. Büsügün is a good example. They are investment-heavy solutions, expensive to operate, and typically requiring physical docks. Then between 2017 and 20, we had explosion of bike shares and then scooter shares driven by venture capital and free float. And sort of the thesis was put as many vehicles as possible, as soon as possible. And that created actually a reaction from public. They did not want so many bikes to be left all around and scooters and so on. So what we see now is regulation for more sustainable businesses, a tighter regulation, a more long-term take from the public side, and they are willing to pay for services that fit a more long-term sustainable play. So here's some criteria that the cities are looking at when they are procuring or giving licenses to different bike shares. Looking at controlled parking, affordability or pricing towards the end users. Do we work with local partners? What are the bike features? Are they long, durable bike that will not be trashed within months? Sustainability profile in both production but also operation, quality of service, and if we recruit our workforce rather than using gig economy. And we do fulfill all these criteria, and we've been very responsible and sustainable in the way we run things. So we've been winning fantastic outcome with the cities. We've been winning most of the deals that we apply for between 2018 and 20. It's been 41 deals that we won where we applied, and increasing number of those are actually referrals and growth. So people coming back again and or referring us to others. This is just to show you the pipeline of what happened in 2020 in the first half, and then in the second half, despite COVID, we had a good year. And here in 2021, it says half one is actually only first quarter results, what we see here. So things are really going fast and heating up and going well in terms of getting more deals in place. Just about our ambition in the next 4 years. This is first showing the 2019 performance we had. It was 33 million kroner that we had in revenue. This was mostly rider revenue. You can see that there was some hardware and some license revenues also. But there was really no B2B or BTG revenue, so no corporate or public subsidies directly to us. And we see a lot of that happening now during 2020 and in our pipeline. So for 2024, what we expect is a much stronger SaaS business, so software as a service, and partners paying us the recurring high profit margin revenues. That's number one in the stack, as you see it for 2024, where we aim to have about 200 million krone revenue. That means about 50% increase year on year in our revenues. And number two there is that we will get these public financing and corporate revenues, which we are well on our way generating. This is also high margin and this is also recurring. And number three is overall fleet growth, and where compared to 2019. Where we will also introduce, or we have introduced already e-bikes in 19, but we expect to increase our e-bikes from about 5% of the fleet to where it is now to something like 30% of the fleet. And with that scale and with those high margin businesses growing, we will be able to turn a profit by 2024. We expect something like 5-10% profit margin. Okay, and just to give you some sense check here, Donkey has been growing its operations in on a profitable manner. So if you take the unit economics of 2019 of a bike in our fleet, then we were, and this is established mass cities, which is 2/3 of our fleet was parked or operated in those cities in 2019. Then we were making 317 krone per bike per month. And the cost of rental was about 210, and we had about 70 krone per bike per month in depreciation. So that was leaving us about 50 krone per bike per month profit margin, about 14%. So we've been already running a profitable operation until 2019. Corona had a significant negative effect due to visitor revenue, but we are not sort of promising to run operations profitably, which we haven't before. We have done that. If you look at where we expect to raise the money and how we want to use that, we are well on our way to raise the 100 million kroner, and we will be using that for business development and marketing purposes, for software development, and also for expanding our fleet, hardware development. And then some, about a fifth, we would use for some blockbuster deals if something really attractive is on our way. In terms of fleet expansion, the equity is only going to finance, we expect about 1/3 of the financing needed of the bikes and e-bikes that we will own and operate, because partners also pay for their own fleet. So this is only for the part that we will grow ourselves. And we have the proof of being able to get debt financing for our fleet from the past also. We do the software development in-house. We have a great team. The CTO, my co-founder, leading that, and also hardware development. We have a great internal and external team to help develop our bikes and e-bikes to be the cost leaders and also have a very convenient, very good bike to ride, which many of you hopefully have ridden. And for this, we have raised already 3/4 of the 100 million. We have already raised from cornerstone investors, which includes European Investment Bank, Academica Pension, LD Fund, and Pentwater Capital. So I think we've managed to line up a very strong set of institutional investors, which we have chosen to do so because we want long-term investors who can also scale their investment with us generating good results. Yeah, so we're only raising 25 to 35 in the public offering, which will end in May 12th. So in 9 days, please don't delay in making your subscriptions. It's 16 krone per share and minimum order of 250 shares. So that's about 4,000 krone. Yes, I think that was it from my side. And I see that there's some questions coming in, Michael.
Perfect. I have a couple. I start with it, then we get to the questions. I
Sure.
always get this, the private placement, the pre-subscribers who you already have in, those are in at the same price as now you are public. There's no difference in those two. Is that correct, Adam? I always get the question.
That. That's really also, as I understand, rare, and we've achieved that. Yes.
Perfect. And then you also talked a little about your revenue was hit by COVID-19. Do you have a number? Have you made some estimates on what it might have been if you weren't hit by COVID-19? I know it will always be guesstimates and estimates, but have you made that calculation?
Right. So you can see here in 2020 we had 21.6 million kroner revenue. That's about 3 million euros, and without COVID we would have made 2 to 3 million euros more. So that's 14 to 20 million kroners more. So I think we would be 40 plus million kroners without COVID. How can I say that? We have a very clear and consistent year-on-year visitor revenue, and that was cut down very, very significantly in 2020. So that makes up most of that revenue gap, about 2 million from visitors only. And then it's the bike sales and also local usership that was reduced during COVID. So we are pretty confident that it would have been more in the level of 40 million.
Yeah. So visitors are tourists, just to make it clarify. Visitors are tourists, yes, perfect. And then you used the word that I don't even think I knew, the transport aggregators. Can you explain a little bit? Is that you go into an app of Reiseplan, like here in Denmark or something like that, so you are part of some more bigger way of transporting, first train, bike and such stuff? Is that
yeah, we are already on Reiseplan, and we are already on many such similar apps in different countries. About 10 of them, and we are about to show up in Google Maps. Actually, I was on TV about a month ago, maybe a month and a half ago. We complained that Jump was on Google Maps and we weren't, and actually we got Google to come around, and we are about to get on Google Maps. But in terms of aggregations and so on, I think we'll see more and more people use donkeys through other apps like Free Now or ride-hailing apps or Reiseplan like apps that the public authorities are sort of behind. And yes, we are already part of those apps and increasingly will be so.
There is a question, and I know you probably get it very often, the Lime and the Boy and those very, the models are throwing out a lot of bicycles into the cities, and you might say you operate a different model, but they are still your competitors. Can you talk a little bit about how you can get profitable in a market with those who is running a model, a VC funded model? If you can elaborate a little bit about your thinking about that.
Yes, sure. The key thing here is that we are not only focusing on tier 1 cities and rider revenues. So we have quite a diverse revenue streams, and public finance and public finance, and also SaaS, the partners that we're selling to, are increasing larger revenue streams for us. But also where we are competing with them, we have a competitive product because we are offering a much more affordable trip compared to an e-scooter ride. In terms of e-bikes, we are yet to see Voi and Tier coming to market with any significant fleet and also a good product. Bikes and e-bikes have a lot of synergies. Customers or individuals who see themselves as a bike rider, they don't want to stand on a scooter idle. And customers who see themselves as a scooter rider, they don't want to break a sweat and sort of ride a bike. So, and both on the customer side, in terms of city permits and in terms of operation, we have strong synergies on the Donkey side for running e-bikes and regular bikes. And still, in terms of what you pay for a pedal bike ride, is between something like 1/2 to 1/5, depending if you're a member or if you just use pay-as-you-go, of what you would pay for a scooter ride. So there's a really big difference from a rider perspective. And then we are focusing more on tier 2 and tier 3 cities and not just on tier 1 cities. So there are quite a few ways that we sort of go around or coexist.
Try avoid the hardest competition. Yeah, makes sense. Then there's a question about your data you collect. I know some Chinese models is making smarter cities, see where people move, collect a lot of data on the riders, and then actually try to sell those data as a part of the business model. Is that part of your business model, or is it a privacy model?
Yeah, we have a diverse revenue streams, as you said. You can see here, data sharing or data selling is not one of them. I can't say in the future we will not have any way of leveraging data more towards generating external revenue, but that is not the plan, or that's not the practice at the moment. No.
Are you planning to provide new services like cargo bicycles? I hope the Danish, the Christiania-cyklen, so you can move stuff around. You see a lot of, I see pizza, the vault and such stuff, riding bicycles and such stuff. Are you looking into new business areas like those to distinguish you a little bit and put a little bit extra on the business model? I don't know whether you can elaborate a little bit on that.
Sure. We have a great pipeline of different deals, and we probably would do that a cargo bike deal first, where a city or a partner is willing to pay for that at some scale. And yeah, we're looking at a few potential deals, but nothing concrete on that.
And I shouldn't. And there's also a part of that question that says, are you looking at better bikes, maybe 7-speed, 10-speed? Looks like someone is a little bit irritated about only a 3-speed bicycle here. And then the e-bikes and such.
Yeah, we already have 7-speed bikes in our fleet, and depending on the conditions of the city, if there's hills and so on, then we deploy 7-gear bikes. Good to get your opinion as a rider, and we try to survey our riders regularly to figure out what makes a difference for them. And on our e-bikes, we normally use so far 7 gears, and we try to have best bike and e-bike riding experience. And I think you can also see that our Generation 3 bikes, which we have 100 of in Copenhagen streets, we can see that it is having great effect. Riders are very happy about that. I can show you one bike behind me here. That's the Gen 3 bike that we have deployed in Copenhagen.
Yeah. Perfect. And now there's a little bit of an investor questions. How do you see your valuation compared to the competitors? I don't know whether you want to elaborate it or it should be left to analysts or something like that. And I know, of course, it's a very difficult question because you are the first or maybe the second going to the stock market as a e-bike mobility. How do you see it compared to maybe some of the VC rounds? I don't know whether you have any insight or want to share any insight to that, Adam.
Right. Well, the insight I can share is that similar companies to us are trading at 8 times the revenue rate, let's say, and we have been affected strongly with COVID. And if you take our 2020 revenue times 8, then that's sort of our enterprise value, and that is a very discounted value because it has a huge Corona sort of effect on it. If we didn't have the Corona effect and had sort of the 40 million revenue that I mentioned, we would have without the Corona, then we would have almost double the enterprise value if we use the same multiplier of similar companies. So I think we are actually quite generous towards the investors. And I think if you look at our investor website, then there's a really nice analysis under IPO documents. And in that analysis, there's actually a comparison of 2 other companies and their valuations. So I think you can also make your mind about if we are generous and how generous we are in that sense. But one reason that we are generous, and I personally, I do think that our valuation is on the low side. But I could agree to it because we wanted to have long-term institutional investors, and they sort of they wanted to find a more a value that they could agree to, and that has been also more important for us.
And then there's a question: how far are you with electric bikes, and do you see any price difference on the regular bikes, 3 speeds, 7 speeds, and how do that goes into the subsidies that you get from the cities? Do you see there is some, first let's take the question about how far are you deploying the electrical bikes? Is that ready to be deployed pretty much on a large scale from now on?
Yes. Very good question. We've deployed first 500 e-bikes in 2019. It takes some time to learn the business, and we had already looked into it 2018 and have developed the bike and then deployed the first batch. It's actually quite substantial amount, 500 bikes. We've been running it in 2 cities recently, in Rotterdam and Geneva. We also have deployed them in different cities and learned different lessons. And we are well on our way to deploy the second generation e-bikes. They are actually going to hit the market city in France in June. And we will be deploying many more of those later this year and early next year, generation 2. And we have investigated all the e-bikes that are in the market and that we can obtain both as an operator and as a rider. We've been riding them and testing their sort of how long you can ride before the battery's out. We've been taking notes on every design aspect and also the components they use. We are deep in talks with all the critical suppliers and understand all the, I think, intricacies in running electric bikes. And it's quite a different business than regular bikes. There's a lot more sophistication in running e-bikes. And I'm happy to report that we're at a place where we are ready to scale e-bikes. Yes.
And then does it depend on the subsidies you get from the city, what you will deploy? Will you get more subsidies when you go to the electrical bikes? Because then it's maybe thought as more as a really transport alternative than bikes into the public system.
Yes. So almost all the public deals that you see here had a subsidy element and subsidy or public finance element. And public finance clearly is great because then you reduce the risk that you would make losses greatly. So it's a long-term relationship with the city. So we really like to establish that. Having said that, we will not require public finances to be able to deploy electric bikes. We can make profitable operations as we do with our bikes, also with the e-bikes. But it depends on which city, under which circumstances, how many bikes do you deploy. So we learned that along the last 5-year journey, also with the e-bikes to be deployed and also with the bikes. And it's also the kind of marketing activities that we do. And the great news, I think, for you, the investor, is that we've already have a great track record also with the riders, establishing positive unit economics, that when we deploy the e-bikes, we know where to deploy them. We know where we have a lot of customers and a lot of demand. And we know these customers who are already bike customers are also e-bike customers because it's a very, very similar product. Whereas if you were trying to deploy, let's say, e-scooter or a 4-wheeler, then it would be totally new sort of business and different needs from the customers as well.
Perfect. And I think this one you must be easy one to answer. The story behind your name, Donkey.
Yeah, sure. We wanted something that is for everyone, that everyone can afford. So affordability was a big thing, and something simple rather than at the time, Büsüklün, it was about screens here and you can't do this and you can't do that. You can unlock with this card or that. We wanted something really, really simple that everyone can afford. So simplicity was the idea of a name that would bring us back to nature, and that also was in contrast to Uber, because Uber is also like the high level thing that only few can afford. And then Republic is because, we are very purpose driven, and we kind of feel the streets should belong to people and not to cars. And that's also a recent announcement from new mayor of Copenhagen. So the Republic part is that we want to be part of this movement where we want a better quality of life for people who live in the city.
And there's a question you have answered a little about the competition, but here there's a direct answer or question. Your management team, where do you see them beating the competition? You know, it must be a lot about employing the right strategies and such stuff. So where do you see your management team, the teams behind you, beating the competition?
That's an interesting question. I think you maybe have a look at our company brochure or the company document to look through more thoroughly at our management team. I think we are working together for a long time, and we've innovated in this space again and again. We've developed the first Bluetooth locks that were to be used in a bike sharing setup. And then we innovated the virtual stations rather than doing free float. We've been designing and supplying our own bikes rather than buying off-shelf vehicles from Chinese suppliers. And when I contrast these things, it's again and again what our competitors are doing. You know, they are new teams that some venture capital has sort of put together, and they buy off-shelf products working with one company. And so I think we have also been good at sort of innovating and thinking out of the box. And I don't see that necessarily so much with the competition. So the similar sort of permanent pricing, similar products. So I think we have a lot going. What can I say about the specific backgrounds of the persons in the team? That I think you might need to have a look at their profile and judge, you know, why are we so good as a team?
Perfect. And then a questions on, you've shown your plans onto 2024. What do you see on the other side of this? What are the drivers for growth next to that one? Is this the start, or will it level out here, market size, and will it grow faster in the future, this you think?
I love the question. I think we have tremendous opportunity also outside of Europe. We already see a lot of inbound demand, but we did not put it in the business plan because our focus is Europe. But we can see that Latin America, Middle East, also many parts of Asia are fertile grounds for donkeys, because we have been very focused on affordability and low cost of upfront cost and a low cost of operating, and that fits very well also countries with lower incomes. But also North America and other large markets, we have a very, very good fit. Then there's another aspect, which is that I think you see a strong traction in the market with lease products or leasing a bike. And I believe personally that you can see that between one trip or bike sharing, you only have like a very short-term need, maybe single trip or maybe one day. And then on the lease side, you keep a bike or a car for long term. And I think there is a room for where you can take a bike on the street and then keep it for a month or as long as you want. And what's the difference between then leasing? But in this case, you're flexible. And I think that flexibility is very important. So currently we have either bike sharing or there's bike leasing. And in bike sharing, you pay a lot per trip. In bike leasing, you're not flexible. And I think we can merge the two, where you also pay a relatively low price and you have full flexibility. And if we get that right, then I think we can see many, many more bikes in every city. So you could say, in 10 years' time, we could see 1 out of 5, 1 out of 10 bikes in the city are donkeys, because why not? It would make more sense. Also from city's perspective, I'm trying to work on the advocacy. I have a public policy background that cities should consider making bike sharing free, because they are getting a lot social return. So if they covered €1 per trip cost, and our cost is lower than that, but if they covered €1 per trip cost, and the society is making €3-4 out of each bike trip, then it's a good deal for the city, and we could make it free for the population. And then I think we would have a much bigger market. So I see a lot of opportunities, and I tried to put in 3 different.
Are there any public funding public funding models, it's always easy to say the city should pay, but is
Right.
there somewhere where they can get that money from,
Yes. I mean, firstly, the model where public pays per trip has already been implemented in 5 cities in UK. And so we are quite keen that this is a future, and then we can actually scale the operations more and more. Of course, often they have a ceiling for how much public money they would spend, even if it's per trip. But the way they get the money is from the savings from where they would have costs otherwise. And those costs are from congestion, from public space that is dedicated to cars and other vehicles. It's from public health savings, so people not going to pension early and not generating chronic diseases that brings you to the hospital. So it's not savings necessarily in the specific transport.
But are there any big public funds, European funds that will fund that? It's always the problem you get to the city want to do it, but the budget still need to balance.
Yeah, we have actually a very interesting situation that during COVID, Europe put together a 750 billion, so 750 billion reconstruction budget, which is to be spent on a third of that has to be spent on sustainable activities, sustainable development. And they put bicycle infrastructure as a specific area where that, not the only, of course, area, but a specific area. And that's one of the main reasons why so many cities across Europe are building bike infrastructure like never before. And also there's another part of this reconstruction fund that says it should be spent on mobility as a service applications. So we are right in the cross section of those 2 mega trends that also have huge public financing behind.
Perfect. There's again a question about the valuation, the 16.2 per share. That's you can just ask that how you evaluated the company. I know you have elaborated a little bit that it was probably in negotiation with those big cornerstone investors. Is that you want to stick to that, or you want to elaborate a little bit more here?
Right. I mean, again, if you look at the valuation of the company, it's about 8 times the 2020 revenue, which was heavily impacted by COVID. It is only 4 times the 2020 revenue would have been if we didn't have COVID. And we can say that relatively strongly because the data really, really clearly supports that with the visitor revenue. The reason that we landed here is because we really value having the private placements that we have, because these are long-term investors that will scale with us their investments if we need that in the future as we grow our ambitions as well.
And there's a question about plans for expansion. Do you plan to do more direct investing as you have done in the Netherlands? How much of your investing is going into, driving your own, mobility services and such? So I think the question is about. Yeah,
I mean, you can see in this chart that this is the dark brown is 2019 and the dark brown here is 2024. So most of the revenue here was coming from mobility as a service, where we own and operate the bikes. Here, this is about 200 million in total, so it's not to scale with the 33, but a lot of the growth is not just depending on the rider revenue. There is significant growth. So we will grow that maybe to something like 3-fold the amount that we had here on mass revenue. But it's not the only area. So some of the growth in this area will be going to the cities where we already are, just growing the fleet where we already are. And some of it will be new cities. And we'll see where they are. And I can't tell much about that, unfortunately. And then you can see that some of the growth is coming from partnerships, and especially this SaaS growth is a lot. Many of those are smaller cities. So if you look back at this map, you have these brown dots, and from Switzerland to Finland to UK, we have quite good traction with our partners. And our first focus areas is all of Europe with partners, but we are also looking at outside of Europe, for strategic deals.
So the place we want to do the investment is that if you see that there really is a huge subsidy that fits into your model as a public fund, so you can see the profitability side even with large competition, or what will you be the decisive factor for you to invest in more in your own fleet?
Subsidies are clearly makes the decision for us very easy, but we also have great potential with corporate sales. We've only very much scratched the surface there with corporates, but also rider revenues. And again, we have been able to run operations on a profitable basis. So we can run bike share, e-bike share in many cities also profitably without subsidies. So if we have subsidies, that will probably take the priority. And we have quite a strong subsidies pipeline. One of them we mentioned in the company description is in Belgium, a large area with Antwerpen. We're very close to actually having something there. And then, there are many deals like that has quite substantial subsidy element in it. So that will be the driver. And then we can also do it in other cities where we have healthy rider-driven unit economics supported by corporate sales.
And then there's a question, which always is very interesting. You had a huge winnings, a good percentage, almost 60% of winnings, but the 40% you lost, what was the factor behind? Did you look into that or to see, to investigate that a little bit more, the 41%?
Yeah, sure. Of course, there are cities who have already talked to an operator or a local company that has a deal with another operator, and they design the procurement to fit into that company's structure or product better, let's say. And in some cases, they are actually not part of the EU tender law, and maybe it's not the public body procuring it. It's maybe a utility company, and then they simply have a relationship or some kind of bias for another operator. And in some cases, there were features that we chose not to put into the deal because that's not the direction we want to take. But it's more the exception than what we see, and it's very different kinds of reasons. So we don't have like a repeating reason that we are losing to.
Perfect. And the bigger risk that keeps you awake, besides Corona, that you don't get to mention, Adam, is the other risk? Is it the public funding not coming as fast, or where do you see the biggest risk on your business model, besides Corona?
Bike supply chain currently is very much stretched. And you can see that every bike retailer is complaining about the same issue, and all the large global brands, everyone is under pressure to deliver bikes that people want. It's a risk that we are working around all the time. This is one of the key areas that we're trying to solve to fuel our growth.
But I think you answered the question and also the next one, because there's a question here. There's a shortage of supplies. How do you deal around that? Is that affecting your growth strategies in the short run and the long run, or do you have some remedies to go around that normal maybe the bike shop down the corner doesn't have?
So we've been talking directly with the suppliers who produce our frames and forks and different components on the bikes. So we're not just talking to one supplier who's the sort of intermediary who we buy everything from. And then, if they say, oh, we are delayed, then we are delayed. No, we have a lot of ways to work around solutions. So we are actually making small changes to our design or bike components to be able to, identify the biggest bottleneck components and then work around those components, work with other components to not to delay. And that's the only way we can solve this at this moment.
Perfect. And then there's a little bit of question about the valuation again. The PE figure in 2024, you only guide on EBIT, and he's talking about 100 million ish in the equity value, pre-money valuation. Do we have any elaboration around those numbers, or Adam?
I think I elaborated on that as I could. If you have anything more specific to say about that, I'm happy to elaborate. But yeah, I think the details are in the company description, and yeah. Do you have anything, Michael, that you want to say?
Yeah, it's around 128 on the EV base. So you're right, it's there, and I don't think you're guiding, unfortunately, under the EBIT line. So the taxes and such stuff. So I don't think unless you want to say more than you have in your prospect. So I can't calculate a PE number. Yeah. I guess that's unfortunately the answer, that I don't think you can go further than what you have already said in your prospect. So that you would do if you would give this number.
Right. The enterprise value in 128, if you include warrants and debts that we have, is about 160 actually. So that's sort of the net versus the total EV value.
Yeah.
And in terms of 2021, yeah, we have not given a revenue indication. We will beat our 2020 results, but we are obviously clearly still in a recovery process, and we don't know how badly we will hit the summer season and with the visitors and so on. But we have very good revenue growth on the SaaS business and the partnerships and so on. So yeah, I don't want to say more than that, but we will likely remain below 2019 on the MaaS business, on the sort of the rider revenue part, because of the COVID, as we see so far. And yeah, so it will be a bit of a mix of bags. And still, we will have to talk about some Corona adjustment to 21 results.
And you mentioned 1 to 2 competitors that have gone public. What are the names of these companies? Do you know those that has gone public?
Yeah. So Helbiz, Helbiz, Helbiz. That's an Italian American company that became bought by a SPAC. So it became their information became public because they were bought by a SPAC. We don't have any other competitors, and also Helbiz is an e-scooter company, but they also have e-bike in their portfolio. Yet it's in the pictures only. So in reality, they have not been running e-bikes yet. They've only been running e-scooters. So again, it's a bit of a stretch to say they are really direct a competitor.
But it's the closest, at least, you get from being on the stock market.
Right. So Helbiz is probably as close as you can get. And then in Denmark, probably Green Mobility is a case that can be somewhat comparable if you want to compare multipliers. The great thing about Donkey, we have a SaaS business and a lot of recurring revenues. We have public finances. So if you were to compare with Green Mobility, I think those are some of the upsides here, that we have public finance and SaaS partners who are paying us recurring revenues. And then, yeah, with regards to Helbiz, they are in the business of e-scooters, and we're not doing that at all. Yeah.
Yeah, but I think the last question here, then we've gone through them. How many shares does the co-founders and the management own, and how long is the lockup period? You know, after you've gone to stock market, how much is then tied up? How much do you have your hand on the? I will use the Danish word cooking plate. I'm not sure that that's a very good expression. I don't know whether you can elaborate a little bit on that, and also the lockup period for those shares.
Yeah. So founders, fully diluted, had 26% before the IPO, including the team. We were more like 33% fully diluted. And then after the IPO, we'll be around 40% diluted. So I think it's coming down to between 15 and to 20%. And yeah, so that's where we're going to be. And founders have committed to a 3-year lockup period. So it eases off from the first year. We can have 20% of shares that we can trade after 12 months, and then 40% more after 2 years, and then the last 40% after 3 years. And the new warrants that we will receive, we will have a strike price increase of 30% per year on those. So we are committing to bring the value up significantly.
Perfect, Adam. I think that was a good run through, and I hope a lot of you got some questions answered. We went through a lot, so I want to say thanks for a lot of good questions, and thanks to you, Adam, for taking us through.
Thanks, Michael. Thanks everyone for listening in. Cheers.